we're having to re-underwrite the deals that we have on the books because we're like, do we have risk in here that is inherently higher than we thought? It's all those factors that go into it. And at the end of the day, you can still find good deals. You just have to be more selective. It's in fact creating a harder market in the real estate space.
If you're a residential real estate agent earning $200,000 a year and you want to grow your passive income, this show's for you. Learn the secrets other agents use and hear from experts in our field in order to guide you along your journey to investing in assets like apartment communities so that you can turn your commissions into cash flow. I'm Randall DeCleared. Let's go, baby. All right, welcome back. We are continuing the series on service providers in the real estate space. The last few episodes we've had have been away from the top producing agents. We're going to get back to that, but we've brought on a number of service providers, and today we're bringing on Corey Maxwell. He's an insurance provider with Birmingham Insurance Group. They are branching out, and not just in Birmingham, so they're in the middle of a rebrand, but they're doing nationwide insurance for real estate investors. Specifically, that's where their niche is and what they highly focus on. So Corey and I, you're going to hear how he got started and how they eventually got into the insurance business and how you as a broker or as an investor can maybe tap into an ability to add revenue to your real estate business by partnering with somebody like them in order to sell your own insurance or use them as a referral base to get insurance. So listen through to the end. That's found money, I think, is how we describe it in the show, because it's there. You're doing the business anyway. You're either insuring with somebody else or you are having a bunch of clients that you're doing business with that should be referral money that you could get. Take those tips. Corey's a great guy. We discuss a lot of things right at the end where we get into some more philosophical stuff. That's an interesting conversation. As always, if you're getting value out of the show, please go on wherever you listen to podcasts, rate the show, tell us how we're doing, write a review. And by all means, we look at all of this. I'm happy to chat with you. If you have any questions, reach out to me. Reach me at rm@ridgelineig.com. Happy to answer any questions and chat with you and just get to know you a little bit better. So without further ado, let's get into the show. Let's go. So give me the evolution. Like, how did you guys get started? Like, what's the story? Because it sounds similar. Like, I had a company called SA House Buyers, San Antonio House Buyers. I was like, can't really scale that outside San Antonio. You can, but I'm just kind of curious how you guys evolved and where you started.
Yeah. So short story is in early 2018, I was approached about an opportunity to help a gentleman open an insurance agency. He had always wanted to and didn't have the time or energy or capacity to do it on his own. And so the mutual friend who introduced us mentioned the name. And then I said, oh, okay. Yeah, I've known Ralph for 20 years. We just never talked business. So anyway, that was the beginning of the conversation that led to June 2018 launch of Birmingham Insurance Group as an official agency business. It was going to be your typical run-of-the Main Street type generalist agency. We had some unique opportunities to capitalize on within a group of companies that he owned. And so anyway, I had a couple of buddies who were looking for some new opportunities. I had a job at the time, wasn't really prepared to leave what I was doing. And so we launched. I was the silent partner, kind of the consulting partner, and then two other guys, June of 2018. So we stumbled on, or we didn't stumble on it. We recognized an opportunity in the SFR space because the guy that I'd started the business with owned 300 or 400 properties of his own. He has a property management company. And so as we began to handle those internal requests and needs, we began to network outside of that, get some introductions, catch some traction, and realize, wait a minute, nobody's doing what we're doing, certainly not effectively in there. And if they are, they're not well known at all. They have no presence on the internet. So we made a decision to sell our book of business outside of that specialty, that micro niche of serving single family residential investors. Okay. And so that was, I guess, fall of 2019, August, September of 2019. We went all in. And since then, we've been focused exclusively in the area of serving investors and property managers. We have several semi-exclusive programs, continue to grow. Frankly, our greatest asset are our clients and our relationships. So word of mouth and referral has been how we've grown the business. What makes us unique is that we have a product that's unique and no other technology matches it yet in the industry, which allows us to offer our programs through the web, okay, on a virtual agency platform. And, after going through COVID and one of the three we bought out the original partner, and then we had another partner who went off the rails and we bought him out. And so Jason Henderson and I currently own and operate Big Insurance. We went through COVID and it kind of revealed some weaknesses in our business model. What we initially had planned to do was actually have a white glove concierge approach to serving this marketplace. But what we found is that our staff was getting in the way and duplicating effort rather than creating efficiency. We decided to, move away from a staff-based agency, and then began at that point somewhere around October of 2020 to really focus on, utilizing the technology that we had available for us at the time and continue to. And so it created some unique challenges. Okay, how do we get the word out? Because the most frequently asked question that we had was, why haven't I already heard of this? And my answer was, exactly. That's the proverbial cat we're trying to skin here. And so anyway, we did our business planning and found that, hey, we're going to focus on relationships, strategic partnerships, customer referrals and recommendations, and word of mouth. And so we've enhanced our presence on social media and really strengthened the engagement there. And so we continue to grow. I don't even know the current numbers of total insured values, but we have a little over 1,500 customers in 38 states. It's a 50-state program, so we're available to do business anywhere in the United States. And so off we go. It continues to evolve, and we've gotten into some commercial real estate, into some multifamily as accommodation in the beginning. And then we found that we actually have a strong referral presence in both of those areas. We're staying in our lane, but we're developing some additional verticals. And so in that vertical, we are also wanting to control as much of that as we can. We're also investors, Randall, so we're fighting the good fight every day. And that fight. If you aren't an investor, you really can't, speak the language. If you don't know what's going on day to day, if you aren't experiencing the tenant problems, the contractor problems, the certificate of occupancy, and how long that always seems to take, right? So anyway, those are the things that make us unique in our space for sure.
Let's unpack that, because there's a lot of stuff going on in there in history and what you guys are coming from. But in general, so you guys are an insurance company. One, I'm kind of curious how that process is to set one up. I don't want to dive too deep into it, but do you just have to be well capitalized? Do you have to have a certain structure for the business? What is the process of getting an insurance company up and running and getting licensed in all 50 states? Because I know TDI.
Yeah. So anyway, let me start with this actually to clarify, because there's a delineation between the insurance company and then the insurance brokers or agents. All right. And at this point in time, we are technically an agent or a broker who represents these insurance programs. We are not the insurance company yet. And then so we have partnerships with several, have proven to be solid markets for us, each serving a different niche within this space. So we're not duplicating our efforts. We're not trying to satisfy and feed multiple families, if you will, off the same loaf of bread. But to answer your question about what does it take, you can string it, but you do need to have some capital, primarily to offset the need for living expenses, right? Because regardless of whether the business is turning any money out, any net profit out, we still have to meet our obligations every month. So I would say well capitalized. And what does well equal? It just depends on the situation. This is my sixth insurance business to start from scratch. And so what I've learned is you've got to have the long view in mind and make decisions based on that long view, that long play, which is 5 years, is what I speak to others who are looking at getting into insurance. I tell them, look, you better plan to make no money in years 1 and 2, reinvest the money that you make in the company in advertising and development of processes and systems that will allow you to scale. Because if you're not scalable, you're going to be stuck in a chair as a technician working on their own, rather than you see the employee status. Well, I can do it better, cheaper, and then I can keep the money that I make over and above what I'm being paid, right? That's the E-myth revisited over and over and over again, right? And yes, sir, you need to have relationships with insurance companies because you have to be contracted with those companies. And starting from scratch, you have nothing to offer them other than your promise, your ability to deliver. And then you need to decide which path you're going to take and those kinds of things. That's the gist of it. Money, commitment, meaning that 5-year view. And if you don't have those things and the relationship, you got to find them.
Yeah. It sounds like the book of business, the way you guys structured it, the way you started, you had somebody who had a large book of business they could just basically bring into the deal. What piqued my interest in the way you said that was you started it, you guys were running that business and then essentially packaged that, or you guys packaged that book of business and sold it?
Yeah, the general book. Yes, we did.
That's an interesting way to set it up. So he made money on his book of business, self-insured essentially.
So keep in mind that the book of business that we sold, we actually grew some by organically, and then some we purchased a book of business. So it was a 50-50. And basically, you're looking for ways to create revenue out of the gate. And so we had some low-hanging fruit there within the group of companies that were represented by the financing partner that we had initially. And then we began making different decisions as we learned more about the opportunity within the SFR space.
Yeah. The reason I ask is because I've talked to a number of like top producing agents, and just in general, as business owners and operators, a lot of the guys who are having success think of, okay, we have this vertical. I've got my brokerage. My brokerage is up and running and I'm making money. My agents are out. How can I expand and include other services? And so insurance is one of them, right? A lot of guys are going out. One of them actually set up their own title company as well because they had such high transaction volume. They were able to capture a lot of the title insurance side of it as well. So I have heard of guys setting up their own insurance, or in brokers setting up their own insurance. So again, that's just kind of like, what's the process? A lot of the thing like we are teaching on this show is to grow your passive income, and building additional streams of income is certainly one of them. Don't necessarily need to go down that road right now, unless it's something that you are like, this is how you do it. We could give it play by play. This is what you want to do. But in general, I think I'm kind of curious on the insurance front around some other things. And again, you unpack that. So we'll talk about investments in a minute. I really want to know what kind of investment you had and the insurance and how the insurance plays for those types of investments. But let's kind of take it back and again, talk about big insurance, right? So you guys are Birmingham Insurance Group. You said you had 2 different brands. You guys are looking to expand that brand to REI Choice,
which was a friendly competitor, and we're introduced by a mutual friend, and it worked out where we could acquire that book of business, that brand. In other words, it was an asset purchase.
Yeah.
And so we rolled it in.
How do you guys compare to like an NREG? Because I've used them, NREIG, I think, something like that. I've used them. What I love about it is it's super simple. It's online. I just go in, I plug a property address in, and they give me a quote or something. Some things that are finicky that I don't love about it. But when you're doing a volume business and you're out there just flipping a ton of properties, it's easy in, easy out. You're replacing something. So again, I want to talk about like how you mentioned something like, hey, we have this technology. Okay, what is the technology? You didn't tell me what that is. What is the tech that makes your insurance program better or easier to use?
It's a little bit of both, better and easier to use. Quite familiar with the NREIG program, as we are actually a retail representative of that program, and we can sell their products directly. So we're contracted with them. It's like the other ones that we're contracted with. And so with our particular program, if you put it side by side with the NREIG, all right, NREIG's program is a good one. Their software is fairly easy to use. Every software program is going to have its quirks. What makes ours unique is that the program can issue new business similarly, okay, through a portal-based access point that each investor would have for themselves. It's private. And in other words, we have back-end access to support the needs of our clients, but they're the only ones from the front end that can access their portal, right? Or whomever they grant access to. And so it does allow you to go in and within 30 seconds, 45 seconds tops, you'll have a quote that's not only a quote, but it is a bindable number that if you like it, want to move forward, you click bind and you pay for it. And then you're able to email certificates right out. You're able to make the payments there. You can set it up on auto pay. You can pay in full or manually, or escrow, of course, escrow pay at closing or going forward. So our model is more along the self-service line so that you have access 24/7. You have full control over your insurance program, and you don't need us to conduct your day-to-day business as an investor or as a property manager. It is. And again, in the beginning, we were wanting to set ourselves apart by being a concierge type representative. But at the end of the day, the vast majority of investors are mom and pop shop, 10 and under. It's not your full-time gig, and insurance is a sort of a necessary evil, of course, until you need it, right? And then you know that, hey, I made a great decision, or maybe I could have chosen more wisely. But making our program available is to more and more investors out there is our path currently. But staying on the top of that software, the program's been around for years. It began as a force-placed or REO insurance program. And so by the nature of that need, it had to be streamlined. It had to be simple. It had to be fast, and it had to be reliable. All right. And so that 30 years of data and just program development has now taken an accelerated path toward just constantly improving on what's already working pretty well. So that's kind of the gist of it. The simplicity, the speed, the access, those are the three things that set it apart. The program in particular, what makes it unique is there are very few questions. There are no inspections. There are no pictures required. We don't care about your loss history or any of that. You plug in an address. The software generates a replacement cost estimate. So in other words, most people have no idea, what is it going to cost to replace this house if it were to burn to the ground? They're looking at either what they have in the house from the purchase price, the ARV, which is probably the closest, but not necessarily. Then you have market value, right? But none of those matter. It's all about what does it cost me to put this property back as it were if I have a total loss. And so then you choose your number of insurance, you input your annual rental income figures and make one other choice and you're good to go. So it literally takes like 30 seconds. Once you've done it a time or two, it's done.
Yeah. Have you seen anyone making huge mistakes in that they are either underinsuring or overinsuring their properties and wasting a lot of money?
Here they are right here. You see this hand up? We've already made them all. You can't break this thing.
So I've been in there and asked you, like, how do you want to insure this property? You can definitely mess it up. Maybe talk about the difference in replacement cost value and the actual cost value and how those two insurances differ. And on the rehab side, you're always getting a certain type of insurance, right? And builder's risk and all that stuff. I'm sure you guys are including in that. So maybe speak to that for those who don't understand what those things are.
So our program has two options, but we only endorse the replacement cost value. So there are two options, generally speaking, when it comes to placing an insurance value on an investment property. And we're going to use insurance terminology here. So the one is replacement cost, which means that we will pay to replace the damaged property up to the limit of insurance as it relates to replacing the property. All right. Most insurance is going to have what's called a co-insurance clause, which says that if I don't insure the property to value or within 20% of the actual replacement cost at the time that I buy the insurance, then I could be penalized in the event of a partial claim, kitchen fire, toilet backs up, pipe burst. Okay, these aren't going to destroy the whole house most of the time, but they're going to cause significant damage. And so as an investor and knowing that flips and other things, when you buy the property and you put money into it or whatever, you're going to end up selling it in that flip situation. And so you may want to insure it at the value of money that you have in that property, right? So for example, if I buy a house at $100,000 and I spend, let's just call it $25,000 fixing it up. So I have $125 in it, but the ARV might be $175, right? So we think, okay, well, I only have 125 in it. So why am I worried about it? I'm going to sell it anyway. I'm flipping it. Well, because our program includes, yes, the builder's risk component, which includes the materials and labor as it relates to the construction in progress, right? Once it's habitable again, then builder's risk is no longer applicable. But let's just say that you bought the house in a part of town that has depressed value. So even though the ARV might be $175,000, the replacement cost might be substantially more than that, right? Because construction cost, labor cost, those kinds of things. If it's a 2,000 square foot house, I mean, we used to see $125 a square foot would build a house back, right? And I'm just speaking specifically to the Birmingham market. Okay.
Yeah.
We're talking about builder's grade materials, that kind of thing. Now it's upwards of 175 and the delayed construction time, right? So it's taking longer to get these things rehabbed. And so therefore the cost of construction is substantially higher than in quote unquote normal times in the marketplace. And so having a property insured to value prevents any potential shortfall in a claim situation. And it also makes sure that what you intend on your insurance program to deliver at the time of a loss is delivered. So what you're investing in is a guarantee, the promise from an insurance company to do what they say they're going to do, right? And so since this is a unilateral contract, here's what I want to have happen. I'm paying my premiums. It's on the insurance company to deliver at the time of a loss. To address the flip side, the ACV, which is actual cash value, that version is simply cost new minus depreciation equals ACV. So, of course, as we know, different components in a construction project, if you will, are going to have different rates of accelerated or not depreciation. Some are 27 years and then some can be accelerated, especially if you got a higher value home that you actually do a cost segregation analysis. And that's another topic that we can get into later. But ACV is going to get you kind of like what you have in it. Then replacement cost is going to allow you to reconstruct that property as close to pre-loss condition as you can, and then allow you to continue that asset to build equity, to continue to have cash flow from that asset, and then obviously can have the opportunity to sell it at a later date at a profit, right? So we all know that there are multiple cash flow or cash accumulation, wealth building benefits to investment property. And that's why we chose the replacement cost route. We begin with the end in mind.
Yeah, sure. So let me ask you then, on that scenario you gave, you're in it for 125, property you can sell for 175, but you're in a depressed market. You think that to get it back to that status at 175 a foot, not to be confused with 175 ARV, then you really need 225 in coverage, just say.
Yeah, or within 20% of that.
Okay. So why 20%?
So co-insurance is the clause in certain insurance policies that protect the insurance company from the masses of mistakes that have been made in recent past. Catastrophic events happened and large numbers of insurance policy of home structures were underinsured, yet their replacement cost said we got to build it back, right? And so insurance companies have been hammered by that technicality, and they're just not going to do it anymore. So there is a clause in a lot of contracts these days that will protect the insurance company from that unknown or unrealized exposure. In other words, insurance works by charging a fair price per dollar of coverage. All right, because all you're doing is swapping dollars for dollars. I'm swapping risk for premium. And so, yeah, that's why I say that you want to be aware. And what's important to have is a relationship with an agent or a broker like us that, yeah, we've got unfettered access to the program. You can self-manage it all you want, but lots of things happen. Hey, I've got this billing question. How do I do this? How do I do that? Especially what happens at claim time, because nobody knows unless you've already been through that scenario before, right? And not many people have been through a loss or a claim scenario with a home. Fortunately, it doesn't happen a lot, right? So we are there to fall back on. You reach out to us and you're talking to one of the owners. Okay. So what we do is we respond as if we were in your shoes. I mean, we make two promises. Number one, we're going to shoot you straight. Number two, we're going to do the right thing. And those are our two main commitments. We're going to have fun in our business, and we're only going to do business with people that we know, like, and trust. So that just lends to a better business relation. Well, any relationship, but in particular here, the better business relationship there. And it also allows us to, or challenges us to, continue to bring value and earn your business every day.
I guess let's keep it on the insurance. If, again, as a consumer, when I hear, yeah, you should do this higher, like you should insure up to 225 in the scenario that we just gave. Mm-hmm. To me, I'm like, well, you just want me to do that because my premium is going to go up, right? You want more premium. So like, again, how do you find that proper amount to insure? Sure, you're trading risk, but on the insurance side, you guys are obviously skewing it to you need to make a profit, right? You're not just doing it out of the goodness of your heart. So it's like, again, that's the consumer mindset.
Yeah. So the question as a consumer is, why shouldn't I view that as an upsell? And look, I'm buying this stuff too, right? I mean, we insure our own properties, okay? And so we have to answer the same cash flow questions that everybody else does, okay? And so the answer is, we don't care what you insure it for, because all we want to do is give you the tools to make an educated decision that fits your scenario the best. All right. So you can choose to insure it for less than that. It's not a forced number. Okay. It's a provided number that gives you a starting point because very few people have any idea what the replacement cost is on a structure.
Yeah.
Now, there are just too many variables. And with the ability to invest from afar, long distance investing and remote investing and things like that. So we offer that as a guideline. All right. And it's a new component. And quite frankly, we've had a number of people that we are aware of having a conversation of, hey, I had no idea that I was underinsured this much. Let's move it up. I'm like, okay, that's not our choice. That has nothing to do with us influencing that decision because look, we have houses. I mean, we've got like 14 flips going on right now. We're choosing to maximize our cash flow, and therefore we're willing to accept a little bit more risk on the catastrophic claim side because we can just take that money and go get another house. I mean, we're not going to build that house back. We're not doing ground up construction right now. And so my point earlier, which was our recommendation is always to begin with the end in mind. So if the end in mind is, I want to build this house right where it is, just like it was, or as closely to that as I can, because this is a great appreciation market. There's strong rents here. There's all those things, right?
Yeah.
But in our situation, the flips and the properties is so underserved in the area that we're investing that we're just going to take the money and keep moving. And so it's a matter for us as risk advisors to provide information that allows you to make an educated decision that best suits your needs. I mean, if the cash flow model is such where you've got to pinch the pennies, then pinch them. But just know that if the total loss happens, you're only going to get a reduced amount that you agreed to on the front end as your claim settlement.
Yeah. You get your pennies back.
Pennies in, pennies out. That's right.
So let's take it back. Again, the purpose of the show is we're talking to agents. We're talking to people that want to build some cash flow. So assume that, let's take it from the brokerage side and then we'll talk investments. So on the brokerage side, if I am setting up a brokerage, I'm literally saying I want to incorporate insurance or insurance sales as part of my brokerage to get additional income coming in. What's the best path that somebody could take to doing something like that?
My opinion, it's going to be to partner with someone who has done it before and who has been successful in launching an agency or a brokerage platform, who has arrangements or access to helping find access to capital, helping find access to the markets. The relationships are there. In our niche market space of single-family resident insurance, the carriers just aren't handing out contracts. So we have begun to wholesale our programs, and we have 4 or 5 wholesale arrangements right now. And then we're starting, we have 3 more in process. And so if an agent were interested in accessing our program, then we would be able to wholesale that out. We'd be able to provide that agent with their own sort of high-level platform, okay, their own
white label sort of deal. Okay.
That's exactly right.
You're geared more toward the investor side still. So again, if this platform wouldn't be good necessarily for a broker, a high volume broker who's got a lot of clients, and he says, look, if you sign up with your insurance, you're going to get a discount because we have line of sight on this sort of thing. And they can immediately grow that side. We're proud to be sponsored by Ridgeline Investment Group. Ridgeline has a track record of transacting more than $53 million in assets throughout Texas. Ridgeline is currently looking to acquire 100 to 200 unit Class B multifamily communities between 5 and 20 million in San Antonio, Temple, Waco, Tyler, and other Texas secondary markets. To learn more about Ridgeline Investment Group, visit www.ridgelineig.com.
Yeah, so it also depends on, are you wanting to be a general agency? Do you want to focus on personal lines insurance? Do you want to focus on commercial lines insurance? Do you want to do a mix of both?
I'm speaking specifically as if I'm a broker, real estate broker.
Oh, real estate broker. Got it.
And I do 100+ transactions a year through my brokerage. And I want every single one of my agents.
Sure, absolutely. You asked me my opinion is I wouldn't start an agency. I'd partner with someone in a strategic arrangement, because then you don't have to go get licensed. You don't have to run an agency. You don't have to manage 2 businesses. You don't have to do any of that. You're able to receive a net income that's potentially higher than you would if you started the agency and ran it your own entity.
Had all your cost of goods and all of that.
That's exactly right. Now, we have clients that are still interested in doing that, but we haven't had one single client actually move forward in that regard. When you dig into it and you really look under the hood and see what's going on and what it requires, there's a lot more to it than just meets the eye. You have to sell it. You have to service it. You have to insure it. So you're buying more insurance to protect yourself against errors and omissions or, professional liability exposures. You're likely having to manage additional staff, but at minimum, you're going to take your focus away from your staff currently that's involved 100% in your real estate transactions and divert their attention to learning a new system, learning a new product, being able to service the accounts, speak the lingo. You got to get licensed there. Again, there's a lot of commitment, and 100 transactions a year is only going to generate you $10,000 of revenue.
A year?
Mm-hmm. So insurance is not a get rich quick scheme.
No, it's a book of business. Build. I get that. Yeah.
It's a build and build and build. That's right.
Here's the deal, Mike, on the number of transactions that we have done. Had I set up insurance or something like this a long time ago, and I just built a book of business. One, it's a sellable book of business. When you're flipping a house, you're in and out, wham, bam, thank you, ma'am, you're done. You move on to the next deal. You're not making any more money from a flip unless you want to finance or unless you do some sort of creative thing on the back end where you're renting it out or keeping it, holding that asset. And so, again, anything that we're all in business. So I'm just kind of curious. Again, you could build that up. I could have a book of business and that's sellable at the end of the day that we could do. Some agents do more, but at the end of the day, if I were setting this up and I came to you and I said, hey, look, I have this retail side. We want to actually be able to just promote it and just say, hey, boom. And I want to get a kickback from you. We disclose everything to the clients. Like, what does that look like?
It's real simple. It's a one-page application. It's a 3-page agreement. It's just a standard agreement that says this is party A is going to provide. This is what party B is going to provide. And for that, there's going to be a revenue generated of that revenue. We're going to share it at this percentage. And then
what's typical on a rev share agreement like that?
So usually 70-30. So 30% going to the referring party, 70% retained here at Big.
Again, that could be a way to just increase a bit of revenue.
Absolutely. And our programs have an extremely high closing rate. We're up in the 80s on closing rate from what we provide proposals on or what we quote versus what becomes a client. It's a relatively simple process. We just turn it into a referral process. We've got APIs. We can plug and play in the back of an existing website. Again, it's seamless. And that way you're creating that revenue stream that is consistent. It's saleable in the end, but more importantly, it's building on itself. And you don't have to go start over every day, which is what you have to do with most real estate transactions other than the buy and hold.
Yeah. Okay. So that's an interesting point. Anybody that is thinking or pondering that sort of deal, that is, again, on the title insurance side, that's one avenue. And I talked to another agent about that a while back, and you can go back and listen to that episode. It was AJ Pedersen, I believe. He started his. And so that's always been an interesting thing. And then on the actual property insurance, the thing is it still, like for you guys, are you geared more toward the investment sales and the investment side? So it's maybe a broker that has a lot of investor base that are going out flipping properties and they're listing for them. That would probably be the best fit, it sounds like. Let's jump into the investor side, right? We've got, like I said, I've flipped a bunch of houses. I've been in the investing side more so than the brokerage side. Been a broker for a lot of years, but always focused on the investment. So insurance has always been a thing. I wonder still if I would have set up my own side where I could get a kickback on my own policies that I was creating. It's should have been doing that for a long time. So
yeah, Randall, that's just an example of found money, right?
Yeah, exactly.
The money's slipping through your fingers every day. So as many of those holes as we can plug, right, the better off we're going to be. So yeah, absolutely would have been better to do that from ground zero. But
yeah, I'm learning every day still.
No better day to start than today.
I've made a shift into the large multifamily space, 50 to 200 unit apartments. And so I have noticed that the insurance rates have gone up dramatically in the last year or two. What is happening there? Why? Can you explain to listeners what's going on there?
Adverse selection is what's causing it. We're the largest populations. If you think about it, it's Florida, California, Texas, of course, up in the Northeast, but New York, New Jersey, so you're dealing with the higher likelihood of catastrophic events happening, whether it be fires out west, hurricanes, tornadoes, everywhere else, earthquakes, and again, earthquakes out west, not so much out east here, but that's where the population is because those are desirable areas to live for one reason or another, multiple reasons. When you have a series of years where catastrophic events occur multiple times in the same year, boom, 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 then the loss ratios, which are the insurance premiums, are designed to fund the operational component of the insurance program. And then they're also designed to place reserves or to buy reinsurance to offset any potential claims, right? And so when the ratios get out of whack or go over 100%, then you're in the red from an underwriting profit perspective. And there's nothing that can be done except for change your underwriting appetite and or your pricing. The insurance company says, we're going to make it harder for you to qualify, or we're not going to write insurance in Florida, Texas, California, Louisiana. We're dealing with all this right now. And so further impacts that is that reinsurance carriers like Lloyd's of London, who are behind the majority of these, especially lines of insurance programs, they're going, hey, we're bleeding like a stuck pig here. We're out. Go find somebody else. All right. And so we've been fortunate enough to align with some folks who are creating underwriting profit. Instead of having carriers pull out of areas, we're actually gaining capacity in areas, and we're still full speed in all 50.
What's the difference then? Why are they wanting to go into those areas? Is it we're recapitalizing and we're gaining back the prior profits we lost because we are charging more, like higher in premiums? We're paying for the past.
Yeah, it's sort of like we got to stop the bleeding first. So we're not going to write any more business in those areas where we've been shot holes into our programs. And in some cases, they are completely pulling out of those programs. And then program administrators are having to find other carriers. So we're diversified. Our guys have relationships at that high level and have known that this is coming and are keenly aware. I mean, they're running risk models daily to make sure that we don't run into a capacity issue. And then further, spread among several reinsurance carriers rather than going all in with one. Okay, so it softens that risk as well in the way of losing capacity. And, like in Florida, I mean, we're one of the few companies that are writing investor insurance in Florida at all. You mentioned multifamily. There are fewer and fewer carriers that are interested in writing insurance on multifamily at all. And if they do, and I mean, particularly in these higher risk areas, and if they do, like I'll give you an example, a multifamily broker friend of mine and I have had these conversations ongoing for the last 6 or 8 months, just seeing it coming. But then he had a deal in Louisiana where the insurance numbers that they plug in per door were $700-800 per door. And then the quotes that they were getting back on this deal were $3,000 a door per year for insurance, when the whole deal might have typically been $5,000 per door, right? So it really royally skews the ratios, the financial ratios and the pro formas, and ultimately the insurance cost ended up killing that deal.
For sure.
Right. Or at least freezing it for now, because they were just like, it doesn't work. The numbers don't work. And men lie, women lie, numbers never do. Unfortunately, that's the way it is. So plus you're seeing this huge ramp up in inventory, right? And I was just reading an article in Bigger Pockets this morning about, hey, is this going to be a problem for multifamily? Because we're actually going to have negative absorption rates in some markets. And so if it's over inventory, then there's additional cash flow pressure on those properties as well. So it's not your typical market in anything. And then because of the catastrophic claims, insurance, just like most everything else, is sort of cyclical over time. Okay. And so in insurance, we refer to these as soft markets and hard markets. Okay. So in a soft market, the underwriting profits are high and therefore the premiums can be reduced, right? And still maintain a fair profit margin. But then during a hard market, it's where things like capacity are affecting, and then catastrophic claims and negative loss ratios. So that makes the market raise its price and find that insurance is harder to place. So hard market, soft market. Makes sense?
Yeah.
It's a combination of things. It's kind of like, it's nearly a perfect storm like we had in 2008, but not quite. It's not the same storm, right? but it's having some of the same impact. Look at the banks that have closed, that forced closed. And you wonder, well, our bank, like our bankers, we're having to look at every deal differently. We're having to re-underwrite the deals that we have on the books because we're like, do we have risk in here that is inherently higher than we thought? It's all those factors that go into it. And at the end of the day, you can still find good deals and you can still make it work. You just have to be more selective. And so it's in fact creating a harder market in the real estate space as well as the insurance space.
100%. Yeah. So a lot of the things on the headwind side of the multifamily space has been very difficult to find and make deals pencil. The rates went up, interest rates. We've got sellers who purchased these properties with the floating rates. And when they went up, obviously their underwrites just got shot. And so what their expectation, their sales price, they still have to hit that number in order to be made whole because of how much they borrowed. And yet they can't. And so I talked to another commercial broker yesterday or the day before, and he's talking about being from the retail side. He's seeing more and more deals in actual multifamily deals from lender foreclosures. Like he's seeing that now. He's like, it's coming.
It is.
And so, yeah, the challenge of the rents, you named a few things. So you have more inventory coming online from new construction, Class A sort of type properties that are coming on. It's going to force the rents either down or stagnate, at least in my mind. And then because the oversupply, I think vacancy or occupancy is going to not suffer a little bit depending on the market that you're in, because there's going to be maybe an oversupply. I don't know. Everybody still says that we're undersupplied by so many housing units. But when you have that much hitting and the prices that they're trying to charge for those units, so the rent's got to come down, the vacancy's got to go up, one or the other, right?
Or potentially both is the concern at this point. And it's not every market. It's your big metro market. I mean, I can't even tell you how many large multifamily projects are going on in Birmingham. I mean, Birmingham's 1 million people.
You guys are booming. I get deal across my desk every day about a deal in Birmingham.
Yeah. And so one of the things that we've done as a value add for our customer base and for our referral partnerships is we look for other ways to bring value. And so we actually have multiple lender relationships where you can still get access to non-recourse funding on multifamily deals, right? And at a competitive rate. And so that's huge.
What's competitive right now? What's the prevailing rate?
It depends on the deal, right? But competitive in the 7s. I mean, it's not like...
I saw a guy on a 20 unit. He was quoted 8 something just a week ago. I was like, or I think it was an SBL sort of loan.
Well, and that's what I was going to say is 20 units, you're still not spending a ton of money on. I mean, it's a significant purchase. Don't get me wrong. But you mentioned that you're in the, what did you say, 50 to 500?
Yeah, 50 to 200.
Okay, 50 to 200. Okay, so you're getting into more sizable deals.
Yeah.
All right. So this non-recourse money really only begins at maybe the $2 to $5 million level. So if you're not getting into a project of that size, then the underwriters aren't going to pay a whole lot of attention to it. Right. And so the key, though, is having someone of influence who can pencil the deal and then go, hey, lender, here's a deal I'd like for you to look at. And he gets funded upwards, 90-something% of the time. Okay. And so it's just having a little extra something that adds value to doing business with our agency and with us. And then again, I mean, there's selfish motive here too, right? I mean, we're chasing the same money. We're looking for the same deals. We're seeking all the same answers that everybody else is. We just happen to have more exposure to the deals and the opportunities. And then, had a conversation with a private money lender last week who was referred to us to solve a need for a client. And then turns out, hey, man, I love what y'all are doing. I want a portal. Okay, great. Let's do it because it'll help him close more business, but it gives him control over, hey, we walked through the deal yesterday and I was on the phone with the lender who had gotten the buyer, the client on the phone as well. And the lender was looking at his little lender box, but I was looking at things from an investor who also knows insurance, knows the lending conversation, and actually that he was going to cut himself out of about $40,000 or so of funding when he didn't need to. He was looking at it from, your vision is only as wide as it is, right? So the more information that we have, the more we can expand our vision, and it opens our eyes, our proverbial eyes, to more ways to solve problems. And that's what ultimately we get paid to do as investors.
Did you save him money on his premium or something? How did you actually get to?
No.
Okay. Because obviously that'll affect your debt service.
Right. But what I spoke was truth into the equation. I spoke truth and fact into the equation. All I was doing, again, was giving information that allowed Chris, the investor, to make a better decision for himself, which he agreed to the higher funding amount, which ultimately benefited the lender. But everybody, it was agreed upon. It was Chris's decision. It was Reggie's funding deal. I'm on the outside consulting at this point because he's not a customer of mine yet. And so that's what we do. We have a consulting component of our business. And so we do risk management consulting, and it just comes with it with most of our clients.
Yeah. It sounds like, if you're listening, you should be looking at insurance and thinking about insurance, especially if you're on the investment side, in a different way, and finding a strategic partner who's going to work with you and kind of coach you through what you should be doing. One, it could help with your funding, as you just alluded to just there, but obviously it could save you or repay you if you have the wrong insurance or the right insurance. So I think that's a good, let's cap it there. I want to ask you a couple questions, just get to know Corey a little bit better aside from work. What's your favorite pastime not related to business?
I love to ride ATVs.
Oh, all right. Did not see that coming.
Being outdoors anywhere is great with me, but one of the things that I'm passionate about is ATVs. And it's something that my wife and I can do together, and we can go alone and end up with people out there, meet new friends, make new friends. But ultimately, we're outside, we're enjoying nature, we're having a good time. Get dirty, but so what?
Yeah, no, that's fun. So are there tracks out there? Or is it like, how do you meet other people?
Some areas have public land that's available where you can go, and just trails have naturally developed through the years. What's more popular nowadays are the managed trail systems, the private land. I mean, there's one in Knoxville, Tennessee that's 70,000 contiguous acres. It's 350 miles of trails. I've been half a dozen times or more, and I could still go ride on virgin trails to my eyes.
Yeah. Do you camp when you're up there?
Yeah. So there are places you can, but now I just normally get a hotel or a cabin.
Okay. I didn't know if it was like once you're out, you're hauling ass out there, and then you camp somewhere, and then you...
Now, you can do rides like that. They're going to be more out west. I mean, where you're just driving miles and miles and miles out to the middle of nowhere and maybe making a loop or an out and back or whatever. Now, these are sectioned, and you can go ride all day and then come back to the truck and go shower up and then, have dinner in town or whatever. That's kind of what we like to do. But yeah, there are all manner of different ways to enjoy it for sure.
My neighbor has an ATV and he uses it going hunting. One of my friends has a dirt bike ranch here in San Antonio, or just south of San Antonio. So we've gone out there and done that. But yeah, the one you just described is huge. That is a massive ranch. Yeah.
I've had my time on motorcycles, but I'm not as fleet of foot as I once was.
He's really good on it, but I almost ate it a few times. I was like, yeah, I could use four wheels.
It still hurts to wreck. That's right. And a cage and a seatbelt.
Yeah, that's right. What's the best thing or memory that's happened to you and your family in the last 60 days?
The best thing that happened to my family in the last 60 days, I think it's been the opportunity to serve my parents. They are entering into their later years, not quite in the need of care yet, but it's just recognizing that season is coming and then preparing for that and being able to speak to them and with them. I went through it vicariously, watching them care for their parents. And so it opens up different conversations, deeper levels of communication. And it also allows us a chance to give back for as many times and as many ways and things as they've given to me, to us. And so the cool part is that my wife and I are of the same philosophies as it relates to family. And so there's never any argument about, we need to go do this. Are you in? It has nothing to do with that anymore. It's just like, hey, we need to go do this tomorrow or whenever. My parents live 4 hours away, right? So it's not like we can just jump in the car and go over for an afternoon, or the opportunity to serve them in a way that they've served us and others before, and just kind of be a blessing, in that way.
Yeah, that's incredible. Well said. When we had our kids, it was a complete mind shift it was like, there's nothing as important as family. And so it just has been a growth. And my mom is caretaking my grandma right now. So I'm seeing that vicariously, just like you just explained. And so that's an interesting time, and the way you described the season as well of their lives. So wish you all the best with that and that process. So name one or two people who have been most influential to the way you think or to your success.
Yeah. So my dad is definitely one of those. He's just over time really spoken a lot of wisdom and truth and shown a lot of love and forgiveness. As my business partner, Jason, says, he's allowed a lot of grace and space, but yet stuck by my side and been my biggest cheerleader. And so definitely my dad is one of those. And interestingly, as I get older, that list gets shorter and shorter of who I would include in that company, right? And for sure, I would say a tie for first is going to be God and how he has developed me into who I am now and continues to work on me to be a better person for me, for a representative of how he would have me live my life, of my family. And ultimately, it's permeated into my overall how I approach things and how I do things. So I would say that's a tie for first, and it's in different ways. All right. But number two is one that I didn't even recognize until he passed away in an auto accident, but it was my high school coach. So I went to a small school, about 550 students. Athletics was a huge thing in our school, in our town. The whole town followed the team and everything. Believe it or not, Mr. Ripley, his name's Donnie Roch, and he was my baseball coach and then my offensive line coach in football. I had no idea the impact that he was making on me until he passed, and I began to reflect. And of course, you got to be old enough, if you will, mature enough, wise enough to be able to look and reflect on those kinds of impactful things that were occurring and you didn't even know it, right? It was just shaping and molding. And I mean, I kind of have long hair now. He wouldn't allow it. It's got to be above the collar. I'm going to kick you off the team. I wanted to butt heads, but I didn't want to lose my spot on the squad, right? It's present yourself well all the time. You only have one time to make a first impression. Make it well. You don't have to be dressed up all the time to be presenting yourself well, right? Obviously, I'm not wearing a collared shirt cutting grass or anything, but you get my point, is present yourself in a way that honors yourself, that honors your family, that honors your God or whoever you're representing. I could go on and on with the life lessons that I've begun to sort of pull out of those key relationships. And my goal in recognizing those things is to be able to perpetuate that wisdom and hand it down to my kids, to younger men who seek me out for advice, or circumstantially, I have the opportunity to share something that could be beneficial in their season, in their life. But I mean, like you said, when you have kids, it changes everything. When you have teenagers, it changes everything yet again. And now my kids, so we have 4 daughters. And so now with 3 of them in college and one about to head off that way, you begin to have more adult conversations. And it's so weird to all of a sudden be talking to your child and they're not a child anymore. It just hits you and you go, whoa, wait a minute. We're not supposed to be talking about taxes. We're not supposed to be talking about, credit scores and this kind of, it's just been cool. But one of the things that I commit to is being intentional. It all kind of started with when they graduate from high school, I write them a little kind of a manifesto kind of thing. Like, these are the things that I wish I would have known at your age.
That's great. I like that.
Use them wisely. And so each one is different. Even though there are a lot of similarities, right? A lot of the same things still apply, but there's some individualism to each of those letters, and I have them all.
Awesome. I remember very specifically when I went to college, I know where I was. I know the street I was on. I was walking and I just had this thing and I was like, man, I wish somebody wrote me a book on like how to this or how to like do whatever.
Heck yeah. Give me a sentence. Give me something.
I heard a few things this morning. One, hey, man, I wanted to talk to you about this. I don't know how you are on time, but a self-insurance deal, but that's the insurance side. But the one that applies specifically to this was Capsule. Like, this guy's coming out with a new like social media type thing where you can pre-record for your son, daughter, whoever it is, friend, family member, whatever, and have it go out on a date. So it's like, hey, I remember the first time I was going to college, the first day was like this, and it was so scary, and this is what was going on. And then it just drops into them. And so I was like, oh, that's interesting. I do a thing now where I have a journal for all of my kids, for both the kids and for my wife. And it's when I'm writing in it, it's like, hey, you just lost your first tooth. This is what happened. Oh, man, this is how you were feeling. So those things I like, and I like reading back, but I haven't thought of doing what you did.
It's what you're doing is fantastic. And in a way, you're writing your own scripture. Because, I mean, think about the Bible's been around for 2,000 years, or whatever the stories have been. And yet the information, the knowledge and the guidance and the wisdom in there is timeless. And so, just like what you're talking about with this capsule idea, we all have the fear, especially us men, but we have the fear of dying and not being remembered. It's just this thing that we want. We get to a point in our lives where we don't care anymore about being recognized, or I don't need all that anymore, right? I want to live my life peacefully and happily and abundantly, and the rest is just noise. But we have to operate in this real world scenario and not in a system or the rose-colored ideal glasses on. By doing things like what you're doing, you're in a way writing your own scripture, not in the same manner as a Bible, okay? But it is scripture. It's something that you can pass on to your kids that they will have in their possession and can refer back to. And as parents, the hardest thing that we can do is just do it, is just make it. I mean, you think about it. When I was growing up, we didn't have cell phones or any of that crap, much less. I mean, we still had the dang roto dial or the one that hung on the wall, with a 12-foot extent, curly cable so you could go around the corner and puddle up. Kids are being bombarded with so much madness these days, and they don't have the tools to cope with it. Premature exposure to how many things, right? And so having that ability to document things along the way gives you perspective as things come up, as they arise throughout your children's lives. I think you'll be better prepared to respond rather than react. Always anticipate. And one of the biggest things that I recommend to parents is stay in their business. They won't like it one bit, but stay all up in their business.
I don't think we have any problem with that. My wife is all about being up in the business. I'm like, leave it. That's enough. She's like, no. Well, Corey, man, I appreciate you sharing. I mean, we got some philosophical at the end. I like it. It's for me, having these conversations and like getting to know everybody that I'm talking to a bit better is always beneficial and helpful. I like that we got to that point. So got to know you better.
Well, I insist. How about that? And there's nothing better than meaningful conversation.
100%. Yeah. It's like surface level is only gets you so far there and not far. Well, Corey, I appreciate it. I'm going to let you go. Thanks so much. Have a good one.
You too, bud. Take care.
Surprisingly, most of the agents we speak with got into real estate hoping to gain passive income and become work optional. However, only 1 in 5 ever start investing. Most are simply too afraid to start. Once you get educated by listening to this show, you'll be able to overcome that fear and become the 1 in 5 who are finding financial freedom. Don't miss a single episode. If you want to stay up to date, the best way is to make sure you're subscribed. So if you haven't done that, go ahead and do it now. And we'll catch you on the next episode.